Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm Tom Shellcross. With me, as always, Mark Ainley. Mark, familiar faces on this episode. It's a good one.
Hold on. Woohoo! Happy New Year, 2024. This will be our first aired episode for the new year.
All right, now we have to get the order right with all the ones we recorded. This whole episode, you put a lot of pressure on us, but
I know. We got to put it out there. When you put things out there in the world, either A, you have to hold up to it, or B, other people remind you when you don't, and you feel like crap and you do it. So it's the new year. People are listening right now probably have all these steep goals of growth development, and hopefully you plan that out right and to set yourself up for success. But man, you and me are here to help our listeners achieve what they want to this year, and I'm super excited about that.
Absolutely, man. So if this airs January 4th, which in case our listeners were wondering, is my dad's birthday.
Okay.
But you have 300 whatever days to go make it happen, right? Just go do it. Just go grind one step at a time. Go buy that one building at a time. The new year excites me. It also everyone gets fluffed out, and then by March it's back to the usual people grinding. Don't be one of those. Keep going. Yeah. Even when it sucks, when it hurts, keep going.
Love it. All right, way to start off the new year, man.
So, man, a lot of good bold predictions. Sometimes we've done these episodes and it's been kind of, hey, things will be good, things will be bad. Like, this is a lot of data. These guys came in well prepared here.
Well, I'm hesitant to say predictions because they came with so many facts basing some of these their quote unquote bold predictions, which makes it exciting, but also makes some of the stuff real. And the stuff they're talking about all seem to be pretty positive trends that are going to help everybody in 2024.
Yeah. Just absolutely great episode here. So you got a housing provider tip. Let's jump in.
Yeah. So one thing, housing provider tip of the week. One thing we're starting to do this year for our residents is provide credit reporting services. That's going to help our residents build credit. We'll report to the credit agency, they'll build credit, and they'll be able to ultimately, a lot of them want to buy their own house. So they'll be able to take that next step, and we'll be able to help boost their credit and give them more of a history. So that's one thing we're offering for our residents. There's plenty of service out there. Do it. So you self-managing landlords or other property managers, it's a great tool for, one, if you're reporting to their credit and they know it, it also can help you on the collection side as well too. But we do it for the positive. And if some of that stuff is byproducts of that, helps our collections, and that's great as well too. So check that out. It's definitely out there. If you have any questions, let me know.
All right. It's good stuff.
All right, man.
Jump in here.
Yeah, man. Today's episode, returning guests. We've had each of them on different times. Jake is one of the people on in the top 20 episodes. So he was one of the people that we said in the early on. We're like, oh no, who can we invite? Let's get Jake on here. He's an OG. But today we brought him. We wanted to start off the year with what year is going to hold for all of us. Some of the bigger topics, and bringing Jake and Mike on here today from Axon Group is the best way we thought we could kick off the new year. So without further ado, Mike and Jake, welcome. Jake, Mike, man, I'm happy to be on this today. We're filming this as the year wraps up. And the one thing I want to make sure before going further, in 2024, what me and Tom are starting to build out now is the setup to do this in person. So I want to make sure you guys are the first ones we're officially inviting to come out and do in-person interviews. Are you guys down to do that next year for us?
Yeah, we're ready to look pretty in front of a live audience.
Yeah, we don't got to worry about the backgrounds or anything like that. We want to make you look pretty in person. A higher production. Lance, our guys, setting all that up with the camera. So you guys are.
I like that you asked the professional model, the first person. So we're setting that high bar for everyone.
I figure, he'll be a natural in person. On that,
it's not about me. I'm just looking for any excuse to see you guys in person.
No,
and we're not that far away from each other, right? This is a local podcast, so we can travel to 6 to 8 miles to see each other. It's not a big deal.
No, I'm excited. Listen, I'm excited about what we're working on. I think our goal is to do 20% of the shows next year in person, and kind of have a different element for the people that are watching it on YouTube. And then also, I think conversation could be a little different too, free flowing wise when you're in person. So I'm excited about that. And you guys are the first one I'm inviting.
I love it. I love what you're doing. You're putting it out there. So now we have to finish it.
I know, right? Lance, no pressure, man. Get the shit going, man.
We are on the hook.
Well, here, before we dive in here, Jake, your background is logistics, and mine, the other thing I did in real estate was logistics as well. And they always said that what's happening with transportation, logistics, and how busy that side of the world is, dictates like future. It's a future predictor. Trucking, and I always call it trucking, but logistics is very slow right now. How does that make you feel, for 2024, looking based on that?
I agree with it wholeheartedly. I mean, I've been out of the logistics game for a while, but I think, and I'm no Warren Buffett, but I think he owns some train lines and a lot of logistics companies, and he's been quoted recently saying that lead indicator and his managers and his high ups at his big boy companies were shocked by how down it was in 2023. So yeah, I listen to him when he talks.
Good stuff. All right, so we're going to jump in. You guys have a few bold predictions for 2024, not just the usual, hey, I hope this happens and all the fluff we see out there. We're going to dive deep and have some real, granular conversations. Before doing that, for our guests who don't know, if you joined us recently, Jake was on episode 20, so one of the original gangsters, joined us again at episode 200, where we had a similar conversation talking about, hey, take out your crystal ball. And Mike, you've been on several times as well. I pulled up 138, and I know I'm probably missing one, but if you're not familiar with the Axon Group and with these guys, Mark and I have both used them. We've done deals together. They've brokered stuff for me in the past. Just make sure you are familiar with them. We have a lot to cover here, so we're not giving you guys the opportunity to do the big background, but I don't want to be selling you short. So with that, let's jump in. So the first one here, Mike, I'm turning it over to you. Bold prediction for 2024. We got rates in the fives. Where do you see these rates going? What's going on?
Yeah, so I think that a bold prediction of saying that rates could be in the low to mid fives, even as early as mid-spring to middle of next year, is not as bold as it seems. And just for you guys, I did a ton of research into this, and I ran regression analyses and compiled 52 years worth of data. So this is not just some crazy bold prediction that is just coming out of nowhere. So let me take a slight deep dive into some of these numbers that I found. So I charted out the difference, and this to me was an important differentiator, because a lot of people will look at the 10-year treasury yield as an indicator of the mortgage rates. But why? What is the difference between the mortgage rate and the 10-year treasury? How does that change? So I looked into that. So obviously there's always going to be a spread from what we've seen between the 10-year treasury and the mortgage interest rate. But recently, that spread has been much greater than it has been in years past. And so what we've had historically over the last 52 years is an average spread between the 10-year treasury yield and the mortgage interest rate of 1.73. Okay, so that's just the 52-year average. There's a lot of high outliers. There's a couple of slight low outliers. But right now, as of November of 2023, that's the last data point that I was able to pull, our spread between the mortgage interest rate and the 10-year treasury is 2.94. And so we've got a much larger than average spread between the two. And a lot of that, if you read up on it, is considered to be fear over the inflation rate. So yes, I know what you're thinking. Did I look into that? I did. So I ran a regression analysis to see the effect size of the inflation rate on the spread between the mortgage interest rate and the 10-year treasury. And interestingly enough, it is technically significant, but there's a very small effect size. So there's a lot of math language that I'm starting to use here. But basically what I was able to find is that over the last 52 years, the change in the inflation rate of 1% only makes a 0.2%, 0.2 impact on the spread between the mortgage rate and the 10-year treasury. Now, I've been a little bit wordy. What does that mean? Basically, what it means, to sum it up, is that there is way too far of a spread right now between the 10-year treasury and the mortgage interest rate. It's much higher than normal, and we're due for a regression to the mean. So
just real quick, Mike, historically, how big of an outliner is this? Like this spread that we see right now, has it happened before? How frequently? Just how far off are we?
So interestingly, yeah. So right now we're sitting about 1.21 above where it should be. The 50-year historical average is 1.73. Now, what's interesting is, again, when I looked at the effect size of the difference between the inflation rate and that difference, it's pretty small. And the last 3 times that we've seen this, as some people might imagine, have been currently. We saw it in 2008, 2009, and I think some people know what happened then. And then we saw it in 2000, 2001, which was the dot-com bubble. So what it seems to be, and I don't have enough data to prove fear, but it seems to be fear tied into the changes in the inflation rate and the changes in the economy rather than actual changes in inflation itself. And the longest sustained periods that we've seen of the spread being greater than 2 for at least 10 of the last 12 months were in 2008, 2009, and 2000, 2001, and none of them lasted longer than 2 years. Well, February 1st of 2024 will be 2 years of us having a greater than 2 spread between the mortgage rate and the 10-year treasury. So what does that mean? That means that if we hit our predictions, as of today, we're at about 3.9 on the 10-year treasury yield. The predictions are that we'll be somewhere around 3.4, 3.5 by March, April of this coming year. If we regress closer to our mean, that means that you add 1.73 on top of that, and you're in the low fives. Now, will we fully regress completely to that mean of 1.73? I don't know about that. We're, a little bit high right now, being near 3, but I do see not just some kind of easing of the 10-year treasury yield, but easing of that spread between the 10-year treasury yield and the mortgage rate. And that, along with the easing of the 10-year treasury, should get us to that mid fives mark by April, May, maybe even March.
So, Mike, ton of great information, and I think I speak for both Mark and I when I say thank you for being more prepared for our podcast than either of us are, because that was a lot there that in a short period of time. This all sounds great. How does this not happen? Like, what are some of the things taking the other side of the argument where, hey, rates don't get into the fives, and here's why?
So it would take a bit of a historical anomaly, because when I looked at the data, there's only one other sustained period that was as long as what we're currently seeing. And that was 1981 to 1983. And the difference between the 10-year treasury and the mortgage interest rate was very similar back then, but the interest rates were 13, 14%. So the percentage difference, as a factor of what the actual interest rate and 10-year treasury was much smaller. So what we're seeing is historically anomalous. Now, that doesn't mean that, we can't continue to see an anomaly that just continues forward. There's even over the 52-year history of looking at this stuff and recording all of this data as a country, that's still a very small sample size in the history of, world economics. So I could see there being an outlier that has never happened, but in the history of recording this, that has never happened. So there would have to be some sort of, factor that we're not seeing. Nobody saw COVID coming. Nobody saw, a lot of the things that have happened. There were only a few people that saw the housing crash coming in 2008, 2009. So it would take some sort of outside factor that we're not seeing. Otherwise, we're kind of mathematically due to regress.
Whether you follow politics or not, I think that's going to come into play this year as well too, because I think historically in these election years, whoever is the city, if there's an incumbent, they're always trying to maintain control of the economy in a positive way to promote their reelection. So I feel that's on the side of what you're stating as well too, that could benefit it.
Yeah, and it'll be interesting because the Fed has been so down the middle in recent years, and I will be very curious to see if, I think there are going to be, updates to the federal funds rate. I think they are going to start easing them a little bit based on the language that they've been using in recent meetings. And I think people will probably tie that into politics. Now, years past, it may have happened for political reasons. I think we're going to see a little bit of correlation that may not be, causal.
Mike, great stuff. Really appreciate it. We have 1,000 realtors on Instagram all saying rates are going to drop. Rates are going to drop. Thank you for providing some substance.
Sure.
So, with that, let's move on to another bold prediction here. So, Jake, you feel there's a certain class here that's going to be booming. We're talking 10% plus increases in value. Let's talk about it.
Yeah. So, big bold prediction number 2, and it's not crazy bold, and it is just coincidence that it's the type of multifamily that Mike and I serve a lot of. But I think in 2024, values for 3 units in the 600 to 750K range, and also 4 units in the 800 like million range. So that's 3 to 4 units in the 200 to 250K per unit range are going to balloon at least 10% in value, as of what their prices are today, or Q3 of 2023. So a few reasons, right? I mean, the big one, and this is all kind of contingent upon what Mike just talked about. If rates come down, numbers start to make a lot more sense, right? Additionally, we've talked about it already, or you guys have talked about it on the podcast, and there's a lot of good chatter around the 5% down conventional house hack loan, right? This financing is going to be opening up the doors for a lot of those buildings that previously we couldn't bridge that FHA gap for. And that's right in that range. Those 3 units above 600K, where you had to either put 10% down with a portfolio loan, or you had to force FHA to work, which you typically couldn't because of the self-sufficiency test. I don't think that's gotten legs yet, right? Like, we haven't seen a lot of demand for it. The rates are still too high for a lot of clients coming in saying, you know, we get a lot of feedback from buyers and house hackers in that range saying, like, I just want this to break even post move out with about 10% down, right? And right now it's just not happening, right? Just because the rates are too high. But if rates come down to the mid fives, all of a sudden we're seeing, like an example, $700,000 3 unit that's collecting, call it $1,600 a month per unit. So $4,800 gross for a $700,000 3 unit. Pretty realistic, right? At a 5.5% rate with fair, you know, everything else, taxes, insurance, expenses, vacancy, all that good stuff. That's a break-even property at 10% down post move out. Again, not a home run, but when we're talking to clients and we're poking around the MLS, that, if it's in a good neighborhood, it is a win. And it's just not happening right now, but it would happen if we dip into the fives. And I think we will. So this just hasn't caught up. There's this pent up demand. House hackers have money. They haven't done anything in the winter. I think in March, April, May, it's going to get crazy. And those neighborhoods with that inventory are going to see a big boom. Neighborhoods that have those, you know, far northwest side, south side, few to kind of point out that had the highest density, and I did a quick search: Albany Park, West Irving Park, West Rogers Park, Portage Park. These are the north and northwest sides. If you go south, East Woodlawn, Bronzeville, Marshall Square, kind of little village areas, these areas that are kind of fringy. But I just don't think it's caught up yet. And I think if you can scoop any of those buildings in that price point right now, call it a 600 to 700K legit 3 unit that have slightly under market rents. Maybe the rents are in the 1,400 range, but they can easily be in up to 16. Those aren't going to last. Buy them now.
Well, think about the opportunity with the new loan programs. The amount of people that now can qualify, or just say have the down payment, right? There's people that save for 3-4 years to get that 20-25% down payment. Now they only have to save for a year. You know, and so the time between I want to buy and the time I write that first offer, or I start actually making moves happen, has shrunk, and that will only create more buyers, which will ultimately drive our pricing. So I can see how that can definitely play into what you're saying.
Well, and then in Chicago, real quick, you know, because our housing pricing, especially on the north side, it's high, taxes are high. Like, how many deals actually pass the self-sufficiency test? It's definitely a minority. It's a minimal amount, right? If you put 10 deals out there, maybe one will pass self-sufficiency. Like, FHA is a great program, but the 3 to 4 unit game on the north side, it's almost, I don't want to say it's unicorn, but it's tough. Like, most of them will not qualify. And now with 5% down, like, you don't have to worry about the self-sufficiency. Like, that's just a huge point that we gloss over here.
And I don't think the 2 units, maybe the 2 units in that like 500K range, I still think there'll be demand for them. I just don't think they're going to see that big of a jump, because you could still already do FHA for those, right?
Yeah.
Even the 2+1s with the bonus units, you can still buy a $600,000 decent, nice 2 unit with a basement or an attic and just use FHA. You don't need to have this new program. And so it was kind of like I just see it bridging that gap with those, there's still going to be those like 1.3 to $1.4 million four units that are great. And if you can put 5% down and you're okay with negative cash flow, fine, great, go get them. I just don't think they're going to see a big boom because even with rates in the fives, those aren't amazing on paper post move out, right? You put 5% down on $1.5 million place, you're
loan's
probably
too high.
you're in the whole $1,800 a month, right? It still doesn't,
Well, 3 units is the one that the self-sufficiency has failed on more times than not.
Exactly.
So I think
100%.
that will benefit from that the most.
Just to be clear to our listeners too, there's no self-sufficiency test on the 2 unit. It's on 3 units and 4 units. The 3 units get hammered because you only have the 3 incomes coming in compared to the 4.
Right. And to be clear, the 5% down program has no self-sufficiency test and the PMI is much lower. So it's just no one's really going to need to use FHA, in my opinion, unless their debt to income ratio is, not what it needs to be in the lender's eyes, or their credit score, doesn't allow. Otherwise, the 5% is going to by far make a huge difference this year.
Awesome. Bold prediction number 3. And this is one that our listeners will love because we started talking about some specific areas. It was you, Jake, on this show first that came in and started talking about the Southwest side, introducing Marshall Square to people. Like, you've been working in that area for years now. And I'm excited to hear your bold prediction on a couple of these areas on both sides of the city that you think we are gonna make it this year.
Yeah. So number 3, 2024. I'm doubling down on East Little Village, right? So Little Village is the neighborhood west of Pilsen. And we have done deals in East, West Pilsen, Marshall Square. Marshall Square is kind of that neighborhood that's almost unnamed, but straddles the middle ground between Little Village and Pilsen, which I love and we love to transact in. But it still hasn't gone through that like boom. And I think it's coming, and we're starting to see it in some of the new developments, in some of the rent to build in the area. Previous guest that I know you guys know pretty well too, Lauren Stunning, reps a lot of builders in that area that are where the numbers still work to build to rent buildings because the rents are starting to catch up. And those developers, if they don't sell the building, they can hold it and they're still doing fine based on the income they're getting. So
what area? What's the breakdown location wise? Give me the borders of East Little Village.
Yeah, good question. So like East Little Village, I'm talking like up to like, within strike distance of Kedzie, Kedzie and 31st. A little bit further west of Kedzie is fine, but when I say east, I'm trying to stay kind of southeast Little Village, right? Going north of Ogden, that's more like Lawndale, right? If we stay south of Douglas Park, as close as possible to California, we're seeing like crazy rent growth. So for example, I'm using like some Pilsen numbers from a few years ago. So Pilsen had rental prices ranging from $1,300 to $1,400 for 2 beds only about 4 to 5 years ago in certain areas and depending, right? Now averaging $1,900 a unit, right? Current rents in Little Village are very similar to what Pilsen was 4 to 5 years ago. 2 bedrooms are at that $1,300 mark, right? And this is across Little Village, so it depends block to block. But that upside to jump from $1,300 to $1,700, I just don't see it in too many other neighborhoods, right? Like it just seems very, very realistic to expect within a few years those 2-bedroom rents in parts of Little Village to be $1,700, $1,800, $1,900, and we're already seeing it. I just looked at an OM a couple days ago on the 2300 block of South Whipple, right? So pretty close to Marshall Square, just west of California. Recently rehabbed 2 bedrooms, 900 square feet, renting for $1,700. And this is in an area where you can buy 3 to 4 unit buildings that are value add for $100K per door. I don't really see too many other places where you can do that. But I also couple this with, there are other areas we can buy distressed stuff, East Garfield Park, far north side, west, I'm a big fan of West Rogers Park, but I think the development East Little Village is huge too. So I don't know if you guys are keeping track of it. I touch base every once in a while with it, but there's a huge mixed use project that's inching closer at 31st and Kedzie, which is going to be where the new like St. Anthony Hospital is potentially being relocated to, but they're also coupling that with like a $600 million mixed use spinoff, right? There's going to be retail, residential, and things like that. So the medium term rental potential down there, I think, is giant. So, and then lastly, the El Paseo Trail, again, a little bit of a, I think I mentioned even before, so that's a little bit of a long shot, but again, it's speculative, but the 606 was speculative at some point too, right? So if that bridges Pilsen to Little Village at some point and they make it the 606 number 2, you know, the people that got in with the 606 was kind of still a pipe dream and are holding those places now are doing crazy well. So yeah, number 3, East Little Village is the next boomtown.
We
heard it here first.
We spoke about on episode 112 with Cityscape and Stephen Vance about that mixed use. So if you guys want to check that out, and maybe we can link to the website the city has for it. It's very interesting development they have. But what I'm seeing in Little Village right now is, even though you're highlighting East, everyone in Little Village is starting to benefit from the comps that are coming out of East Little Village, which East Little Village then benefited from all the comps coming out of Pilsen. So I know we talked on the show recently about, I think it was Avondale benefiting from the neighboring areas getting those type of comps first, because when there's no comps, then they go east, and typically that's benefited the developer. So that's something that I think all of Little Village is benefiting from. But I think the biggest spikes will be the people in East. I'll agree with you on that.
Yeah, and I think it's pretty interesting that, you know, you mentioned everywhere in Little Village, because I had a chance when we were preparing for this to catch up with a client that bought a 4-unit in Little Village 2.5 years ago and has a 3% interest rate locked in. Good for her. She's crushing it. Now she's got a 4-unit. All 4 are 2-bedroom units. And I asked her yesterday in preparing for this, what are you getting now? She started out with $1,250 rents. She's up to $1,500 for all 4, and she is several blocks west of Kedzie. And now her building is gut rehabbed and was gut rehabbed several years ago. So it is a very nice building, but several blocks west of Kedzie, she is still getting $1,500 for all 4 of her units. So it is definitely moving that way.
The one thing I think you guys agree with me on, or correct me if I say this the wrong way, in Little Village, there's a lot of different types of floor plans. So a 3-2 might be 800 square feet compared to a 3-2 down the street that might be 1,500, because the housing stock was built so differently for the back of the yards historically for the blue collar side. Those floor plans and all that. So just always be careful when you're comping that stuff out over there.
Yeah, no, I agree, and I think the not a counter to that, but the expectation is not a lot of people are moving from the north side to the south side, right? So usually you get people that have lived there that are upgrading from a different block, so they're used to those layouts typically. But yeah, if you're shopping in, you know, Avondale and then jumping down to shop in East Little Village, you're going to definitely notice a difference.
Yep. All right. Good stuff. Let's move on to bold prediction number 4. Turning it back over to Mike. Mike, we're talking downtown condo prices. I don't think we've touched on this in the show. Let's dive in.
Yeah, so I think the bold prediction that we're going with for this year is that, and it may not be that bold given the trends, if anybody's looked at the trends, but I think we're going to see the condo prices finally be positive for the first time in several years. So a lot of people, if you invest in condos downtown, or if you just own a condo downtown, you may be very disappointed at, you know, what your condo is worth, or if you've had to sell your condo in the last several years. I've been lucky enough to help a few friends buy condos downtown and bought them in 2022, 2023 for prices lower than they were bought for in 2019, 2020, just because when COVID happened, so many people who were living downtown, because they had to be close to their job, they had to, you know, walk to work or whatever their reasoning was, realized, hey, I don't need to be here. I don't need to work at work anymore. I get to work from home. And there was a flooding of people out to the suburbs, and there was a flooding of people even into condos that are, you know, in the city, but not downtown, you know, Lincoln Park, Lakeview, Wicker Park, those areas we've definitely seen a ton of demand in, but the downtown condos went backwards. They were quiet, and there is data to support this. So 2020 into 2021, based on the HUD data that I was able to find, we saw a 12% slide in the average value of downtown condos. Now, that started to alleviate a little bit as we got into 2021 into 2022, when it went down 3.8%. And in the last year, I found a couple of different sources, but it seems like the most reliable is that we were down about 1.6 to 1.8%. And I think that easing of the slide, coupled with the fact that bold prediction number one, interest rates are going to go down into the fives or at least go down a little bit. We're going to start to see people buying those up again. The prices are just too low for what you're getting. People still need somewhere to live. There's still a growing population in the US. You know, Chicago is still a major city. There are people that have gone back to work. And I just think the affordability, along with the fact that, you know, the prices have gotten to a point that I think is a little bit too low, we're going to start to see those start to bump up again, and people are going to start buying downtown condos again. So if you're an investor, it may be time to say, hey, you know, if I'm looking for a long-term play, maybe I can do a cost egg and I don't need immediate cash flow. There may be some appreciation to go along with a tiny bit of cash flow, depending on how much you put down, if you're looking to buy an easy, manageable downtown condo.
I like it. Good stuff. Any comments on how HOAs have changed, right? If they have less revenue coming in due to either more vacancies or just lower price, like anything to add there on that and how that might affect numbers?
Yeah, it depends on each HOA, you know, as you know, and a lot of people know, depending where you're at, you know, you've got your old buildings. If you're in the Gold Coast, those HOAs are out of control. They're older buildings. But a lot of these downtown condos that, you know, have lost value are not that old. We have a lot of newer condo buildings in Chicago. You know, there's a lot of your old ones. Like I said, the Gold Coast, if you go down Lakeshore Drive into Hyde Park area, it's not unusual to see a $200,000 condo with a $1,500 to $2,000 a month HOA, because there's amenities, yes, but because the building is old, because it needs upkeep. But a lot of these condos have been built since 2000 or late 90s, you know, mid 2000s. A lot of that stuff in the South Loop and downtown is newer. And so a lot of the CapEx items have not had to, you know, occur. Now they're going to have money for that, but they're not regularly outputting a lot of that HOA money. So I think a lot of them probably have been able to sustain having a little bit less income. You know, but I think that for the most part, people still own these. People are still paying their bills. They've just seen the value of their condos go down. But these condo associations aren't really changing their HOAs. There may be some where they've had lost revenue, but I think for the most part, they're going to probably still be pretty healthy.
I think a lot of condo inventory has been removed from the market from other conversions that I think is definitely something that comes into play.
And I think the conversions are very important. I think we're going to see more conversions. I think, you know, the one thing that I could see potentially hurting the condo prices, and it won't be this year necessarily because it's too quick to have these level of conversions. But as you guys know, and I know we're talking mostly residential here, but office space has still not come back. And there is a lot of office space that is in a lot of trouble. And it would not surprise me, you know, in a lot of other places to see office space converted into condos. In Chicago, there may be some where that's applicable. You know, time will tell whether or not that's a venture that some people want to undertake, and that could flood the market a little bit with new condos if they end up going that route. But we still have a very massive supply shortage in terms of overall housing, and so I think at least in the near term, we're going to see some bump in that value.
I'm putting you on the spot. You got to buy a condo. I know it's all price dependent. Give us the one neighborhood you're looking. Mike Scanlon needs a condo. What's the one neighborhood you're going to throw out there for our listeners?
I'm going to say South Loop. You know, I think that they're a little bit further south than the South Loop. You know, I think that there's been a lot of stuff being built up right around Grant Park. You know, you've got a lot of high end stuff around there. But as you go further down on, you know, Indiana and Michigan, there's still some properties that are newer. The HOAs are not very expensive, $200 to $300 a month, and they're still very accessible in terms of price. 2 and 3 bedroom condos are still going for, you know, 200, 300,000 without excessive HOAs. They're big floor plans, and it's still a very easy, you know, drive or train ride into the city. The trains go down there. You know, you've got Lakeshore Drive, you've got easy drives up Indiana and Michigan. So I'm thinking that, you know, I think the high rises and the crux of what I'm saying here is that I think the high rises come back, but I think some of the low rises in the southern part of the South Loop are going to do very well as well.
Man, what you get, it amazes me, like what you get for the money between 13th and Cermak, like down there,
Yeah.
Motor Row and stuff like that. Like it's just amazing, like what you could get for the money. So, and some of the, especially some of the loft ones too, that they're amazing. I prefer the lofts over the new construction any day, just because what you get in the wideness and the So,
yeah. And I think one of your indicators, we talked very early on, Tom, Mark, you guys talked with Jake about logistics and everything as an indicator. One of my favorite indicators, I own a condo in Wicker Park, and right on Western around, North Avenue between Division and North. When I first bought that condo, a lot of the stores that were up and down that little stretch there were local stores. They were, a little bit run down looking. And over the last 3 years, they've turned into really nice storefronts, doggy daycares, and, very, hipster-ish, type places. And you're starting to see some of that move into some of those retail shops that are along Indiana and Michigan as you get further down. And so if you watch the retail and you watch the level of stores, better storefronts, higher end businesses, you're going to start to see the residential follow.
and we're going to throw a rooftop party 2100 block of South Michigan this spring, or once it warms up. So that's gonna be fun. So look out for that, everybody.
Hey, you put us on the hook for a lot here.
Yeah, you got to put it out there, man. That way people ask and hold you accountable. So, or we do it because we don't want to be dumb, feel stupid.
I do like the doggy daycare as a leading indicator, though. I'm gonna scout that out.
Well, think about this: you have local residents that have the cash to be able to afford a dog, let alone the ability to pay. I mean, doggy daycare is not cheap. I mean, doggy daycare is $40-50 a day now these days.
Yeah, and it's funny too, because the only reason I threw that out there is because there is an actual doggy daycare that popped up. I don't know what it's called. I wish I did, to give them a shout, but on Lemoyne and Western. And that was one of the first things that I saw after I bought the condo that I own over there. I was like, oh, that's a good sign. There's a doggy daycare on the corner now, because I think it used to be like some rundown mattress shop or something like that. I'm sure it was great, but yeah, all of a sudden it turned into a doggy daycare, and they've got high-end graphics and all this kind of stuff. So that was very much top of mind.
I was just down there. Even going south there, like Augusta now, running east-west is all starting to get built up.
Oh yeah.
So, all right. We got one more, right?
Yeah.
Number 5.
Cap rates, multifamily. A lot of people would love to hear this. So let's hear what you think about cap rates on multifamily.
Yeah, I'll get it rolling. So yeah, for number 5, bold prediction. Predicting cap rates will expand by as much as 1% for multifamily. And I could say that for commercial, we'll focus on multifamily, 5+ units, which is technically commercial. So what does that mean? I'll use an example. So a $1.4 million 6-unit, let's call it, that has $100,000, $100K NOI, right? Which should be standard, and that's a 7 cap, right? That's based on math. $100,000 NOI for a $1.4 million 6-unit is a 7 cap. If that expands to an 8 cap, the value drops from 1.43 to 1.25, right? So there is a rule of thumb, that roughly 1% expansion leads to 10-ish% price drop. That's very, very rough. It depends on the price point, but that's big, right? That's huge. A 1% expansion in multifamily is a big hit for these sellers, and we're already seeing it happen in some neighborhoods that were originally trading at a 6 cap when rates were in the 4s, right, in 2021. So in 2024, we're seeing this happen potentially happen for several reasons, right? Rates, even if they come down a little bit, they're still not going to be down low enough to where refinancing these buildings when these loans come due, because most commercial loans are either 3, 5, or 7 years. So anyone that had any type of short-term rehab financing, bridge financing, those loans are coming due, and they have to refinance or sell. There's no other option. So if they or if you're an owner that did a 3-year refinance on a building and cashed out and took all that money and dumped it into another project, which a lot of people did, when it comes time to refinance, they're going to have 2 choices. They have to sell, or they have to bring money back to the table if their value hasn't gone up enough, right? So I don't think people are going to want to ever put money back into a building with refinance, right? Like, it just doesn't happen, and I don't think people ever plan on doing it. So what's going to happen is they're just going to sell, or they're going to have to give the keys back to the lender, right? And foreclosures on multifamily aren't up much yet, but it it's the reckoning is coming. Most people are saying that's more so for office space, but it's going to start to trickle into multifamily. That coupled with we have flattening rental growth in most markets. Chicago still has pretty strong rental growth. We're in the fours now, I think, on average, last quarter and a half or so, but it's flattening. Rents are still going up, but they're going up lower than the increase of inflation. They're kind of matching it currently. So we're going to just see better deals, in my opinion, coming in 2024, right? Like these 6 to 8 units that we're trading at 6 cap, it just doesn't make sense anymore, even if rates come down a whole another percent and a half. So coupling that with a couple other things that are happening, the transfer tax change that was brought up is likely to get approved. So city council already approved the updated transfer tax for sales in Chicago. It just has to go to vote in March. What it says is that any sale between $1 million and 1.5 million will now be taxed at 2% of the amount over $1 million. And then for sales greater than 1.5 million or up to 1.5, and anything over 1.5 is going to be taxed at 3%. So it's a gradual scale going up. But what that means is that these commercial sellers are going to have to be pitching these buildings with buyers taking on a really big cost. So more or less anything trading over $1.1 million, which is most 5+ units in decent areas, costs are just going up. When costs go up and taxes go up, NOI comes down. When NOI comes down, prices have to come down, right? So all that's going to lead to a cap rate expansion where these sellers are just going to have to get more realistic. The brokers who are bringing them to market, stuff that is getting priced at 2022 levels just doesn't make sense anymore, right? So I'm looking forward to that because there's been a lot of money sitting on the sidelines. So there's a lot of demand for it, but there's still not a lot of supply. It's still a little bit of a standoff. And I think the sellers are going to have to be the first ones to flinch, even if rates come down a little bit.
All right, a lot there. I hear everything you're saying, and I do agree with it. Do you feel though like demand? Because right now I still feel like I'll go walk something like there's no way I can buy this, and they're like, yeah, we got 10 offers. Right, demand is still just so high because of lack of inventory. So even if you get a few of these that hit the market, I don't know. I feel like there's enough undisciplined demand out there that will keep these artificially higher than they should be. I'm not disagreeing with you. I'm just saying, like, I'm kind of scratching my head when I'm walking these things, saying, how are people doing this?
I love undisciplined demand. Like that's like,
well,
that's a great
your answer
way to
is
word
the
that.
reason. Your answer is the reason, right? Like it can't last forever, right? Like even it has to come to an end at some point. And I think in 2024 is when it will come in. And I'm not saying those deals aren't still happening. They're still trading potentially, right? But not as quickly and not as easily as you'd think, especially if there's no value add component or upside. Because based on what their leverage is, there's something in commercial lending called DSCR, debt service coverage ratio. And if you're not at a certain number, you have to put more down until you hit that number, right? So what's happening is with rates at these levels, even if they come down a little bit, investors who used to be able to put 25% down to hit a DSCR of 1.2 have to bring, instead of 25% to the table, they got to bring 30%, 40%. So that money, in a sense, is just drying up. So the leverage is just not good. It's just still really bad. And I don't think it can last longer. Now it depends on the class. I think, like Mike mentioned, office is in trouble unless the city allows some type of adaptive reuse. But we're gunning for lower prices, and it wouldn't be a bold prediction if there wasn't any pushback from it, right? So we'll see.
Oh, I like it.
Way to
Everyone
ride
else
that
has
one,
been
Jay.
pie in the sky on it. It's almost like refreshing. Like, oh,
Yeah, and I think it's important to make a distinction here because our initial bold prediction is that interest rates are going to come down. But if people here have not bought both commercial and residential property or worked with it in some capacity, they're modulated by two different numbers here. So your mortgage rate is typically dependent on what I talked about, a spread between the 10-year treasury and what the mortgage rate is. And there is that average spread. I've gone into that. Now, your commercial rates are typically dependent on a spread that the lender has to make between the Fed funds rate and what their interest rate is that they're charging. And we had seen the spread between the mortgage interest rate and the 10-year treasury increase so much so that residential mortgage rates got higher than commercial rates. Now we've seen that reverse a little bit, and I think we're going to continue to see that reverse as that spread reverts to the mean, like I talked about in point one. But there's a pretty standard spread between the commercial rates and the Fed funds rate, and the Fed is not as fickle as the 10-year treasury. The 10-year treasury trades every single day, it goes up and down. Foreign countries are buying in for stability because they still believe in the U.S. economy. So that can change pretty rapidly. And that's what we've seen over the last couple months is that there's been a massive dip in the 10-year treasury. What was it? A month and a half ago, we were at 4.8 or 4.9. Now we're down to 3.9 as of the day that we're filming this. The Fed is going to make very meticulous decisions about when they drop it. They're not going to drop it massive amounts. And so we're going to see that if there is a dip in commercial interest rates, they're going to be steady. They're going to be calculated. And they're not going to provide the relief that people who bought in 2019 and 2020 thinking that they had a good deal because they had a 3% interest rate on their commercial property. They're not going to give them such a good deal when they're going to refinance in 2024, 2025, and all of a sudden they're at a 7% interest rate where it's still sitting today. So I think there's going to be some trouble just because there isn't the ability for a very quick change in those interest rates. And so people are going to be a little bit surprised in terms of sticker shock when they go back to their lender and say, hey, I need to refinance.
Yeah. And just it's an obvious point, but I'll make it. When you start talking about these bigger loans, like it's a much bigger difference than your 500K loan on your 3-unit, right? When you have a $7 million loan, going from 3% to 7%, that like you can't make that up with increased rents. Like you can't. Like it's such a big number. I wish I had the calculator out to go through it, but like it's the bigger the loan base, every little percent makes a huge dent, and all of a sudden DSCR gets really, really hard to hit.
Yeah, it's astronomical. I mean, there's already been talks of some of the major, capital groups giving back offices, and we're not even at the point of some of these, really good, quote unquote, really good loans maturing. We have investors that, in our opinion, did buy a good enough deal to where they're going to be able to get out of it, but they were locking in 2.9, 3.25 in that range for commercial loans back in 2020 and 2021. Those are going to be coming due very, very quickly. And so it also would not surprise me if we do see some, I guess, for lack of a better term, spoiling of the market from some commercial short sales, just because people are not going to be able to make the DSCR work on this at all. And they're not going to have the funds. Tom, Mark, Jake, we're all investors. There are some of us who play it very safe. And there are some of us, and myself included, who have leveraged ourselves and put ourselves in somewhat precarious positions so that we can continue to expand. And now, I don't recommend that necessarily. I've gotten to a point now where I've eased up a little bit and I'm not levering myself as hard as I was when I was first starting. But that there are people out there that are doing that. And there are going to be people that were very, very over levered and did not keep liquidity on hand when they were buying these properties. And so when it comes to call, at the 5-year mark, they're still not going to have the liquidity they need to get out.
Yeah, a lot of syndicators had that cushion of the market being so good that bad operators were limping by, right? Like they just can't anymore, right? So there's just a lot of these operators that were, getting propped up by those low rates that everybody, nobody could fail for a couple of years. And if they had bridge debt and they were doing value add and doing one of those big commercial burrs, which is pretty much what a syndication does, right? They try to exit in 3 to 5 years and pay off their investors. If those operators didn't add enough value, those deals are sunk, right? So these are big deals and they're happening all over the country, but I've been listening to a lot of podcasts on it as well, and the word on the street is like those bottom feeder syndicators, the ones that didn't have much experience, are going to be giving a lot of buildings back supposedly.
Yeah, they got artificially propped up by interest rates, and then they got a second wave with rent increases. Like that was probably the other thing, like offset. Yeah. Like a lot of them would be dead in the water if it wasn't for these 15-20% type rent increases that happen in various markets.
that was Bakovic's point. You know, we had him on 4 or 5 episodes ago, and Sal made the exact same comments of just, you know, everyone was, no one could fail, and now it's going to be who's a real operator, right? You're going to see who can actually do this, and not just with the tailwinds behind them. I guess one more point to make on this, what's I found fascinating with cap rates, you know, because we never got down to like the Arizona buying things at a 3 cap, 4 cap, right? Like, you know, Chicago's still a Midwest city. It's crazy to me that something jumping from a 4 cap to a 5 cap has an exponential result on it as compared to jumping from an 8 to a 9 cap. Like the further you are compressed, that one jump, it's insane. Like you would think it's relative, it's not. So it is kind of nice that like we never got down that low, because those guys are getting murdered, right? Like jumping from a 4 cap to a 5 cap has an exponential effect on the valuation of the property compared to a 6 going to a 7, and then same goes for an 8 to a 9. Like the steadier the higher the cap rate to start, the less the effect, if that makes sense, if I articulated that correctly.
Oh yeah, I mean,
Right.
yeah,
Go
that's
ahead.
just, obviously, percentages. If you're jumping from 4 to 5, you've got 25% increase on your original 4. If you're jumping from an 8 to a 9, it's only a 12.5% increase. So the effect size is half. So yeah, I think you're gonna see that people in those types of markets are going to be especially hit. Your Arizona, your California investors that are getting crushed out in San Francisco as tech moves to Austin and Nashville. I think we're going to be a little steadier here, as we always are. But yeah, we're still going to get hit, but just not as hard as the coasts that typically are.
Jay, you anything to add, or same comment?
Similar comment. I was going to say my example from dropping from 1.43 million to 1.25 million was from a increase from a 7 to an 8 cap. But you're right. If that was from a 5 to a 6, much bigger. But you exemplified it perfectly.
Good stuff,
man. Well, here, before we wrap, you guys give us a lot of stuff today, and this is awesome. And our listeners love to listen to guys like you. You guys are thought leaders in the space. Me and Tom have the utmost respect for both of you guys. You guys are freaking grinders. Like, I know you guys bust chops every single day in a role that you only make money probably 50% of the activities you actually do. But you guys grind. You guys wake up. You guys clearly have a passion. You said things today that people that don't have passion will never be able to ever, even if they practice and memorize it, couldn't say. But you guys have amazing energy, amazing passion. I just want to compliment you on that. But what makes you guys tick? What gets you guys up every morning? What's keeping you excited? Whether it be about 2024, like help our listeners understand, like, you guys are such thought leaders and such leaders in this whole investment minded broker space. Like, what is it? What gets you guys going, man?
I mean, I'll say what gives me the edge on just knowing some of these things without having to do a lot of research is underwriting deals, right? You have to be underwriting deals for either yourself or other people constantly, or you won't be able to keep up, right? You can read articles, you can listen to podcasts, but until you're sending yourself deals to look at and setting yourself up on searches, it's a little easier for brokers to do directly, but you don't need to be a broker to do it, right? Question the numbers and crunch them and compare them apples to apples, right? Because if you're not putting deals out there, you're not taking swings, you don't really know what's happening, right? You're just trusting someone else's opinion. You need to see it on paper. So what gets me up and what gets me going is trying to find those deals for other people people that I'm close to, because their success equals success for me. So underwriting deals.
Yeah. And, I think I'll take a slightly different approach to it. And I think Jake probably, if he took the same approach as me, would have a very similar answer. So, Jake has a family. I don't have a family yet. That's what gets me up in the morning, is I want a family. I want to, provide for them. But I take it from the approach of, I am still, even though I work as, a real estate agent every day, I still am investor minded every single day. I own a, pretty sizable portfolio at this point. And I work with clients because I want to see them achieve the same things, but I also want more. I want to, be able to show them how I did what I'm doing, and then use the money that I made off of showing them and helping them purchase these properties so that I can buy more, so that eventually, one of these days I'm going to be able to just live off of those cash flows and just, have a little bit more of what we all, I think, are trying to do. Like, you got to have your why that, goes beyond money a little bit. And, being able to, have a family and provide for them and be there in person and, live off of those cash flows that, we've been grinding for years for. But the process is then what gets us to the point that we can work directly with people, because anybody who comes to me and says, "Hey, I want to buy a property. Do you know what you're doing?" I'm like, fortunately and unfortunately, very much yes. So, we live it every single day, and, we can help in that regard. But, that's the why behind what gets me up every morning.
That's awesome, because I think everyone starts off with money, thinking money's the why, and you guys more. I'll paraphrase what you said. It was more about the bigger things in life, and those are the things that get you up. And you guys probably are in the position where you could probably live conservatively for the rest of your life right now and barely work at where you're at right now. The successes you guys have had, so it's exciting to see your type of energy when it becomes more of a purpose than it is a financial marker.
Good stuff.
Yeah.
Mark, ready to wrap?
I'm ready to wrap.
Bring
All
it.
right. Oh, along those lines, what's your guys' competitive advantage? How have you been able to do this while so many others wish they could be the Axon team?
I will steal this one first and, just kind of say that Jake and I both share the same mindset in terms of we hustle. Like, if I call Jake at 9:30 at night or 7 in the morning, he's answering. He might be out of breath when he answers, but he answers. We're both working, all day, every single day. And I think there's a mixture of, we're in Chicago. You take a look at our greatest athlete of all time, Michael Jordan. And what did he have? He had an incredible amount of talent. And I think we do have that. Jake's got a business background. I've got a business background, and we both own property. But you couple that with his competitive spirit that was unparalleled, maybe Kobe Bryant. And we both have that. So it's a very good pairing of, hey, we're doing this stuff every single day as investors ourselves so that we can translate that information. But we also want it really bad. We wake up and we start working first thing in the morning. We're working till very late at night.
Yeah, hustle. I'll go back to the logistics, analogy a little bit. And Mark, you were in it too. I think like having some type of sales commission only background helps everybody. Anyone wants to get in kind of that real estate game and make sales, whether it's wholesaling or making cold calls or getting into it. First start off as a caddy when you're 13, work for tips. Then get a job as a third-party logistics broker or in a trucking company, because that is the ultimate hustle and the ultimate grind. So, background helps. It's hard to jump right into stuff. So I'll attribute a lot of it to that.
Good stuff. No, I love that answer. All right, guys, what is one piece of advice you would tell someone that is yet to buy their first property here in Chicago?
Find a good quarterback, right? Talk to someone who knows what they're doing. Self-plug there, right? And it's been said before, but I think a real estate agent is a perfect person to connect you with lenders, property managers, attorneys, especially if you're out of state. If you already have those relationships, then make sure you're connecting with someone that's actually, like I said, underwriting deals and putting deals in front of you. Anyone can set you up on a search. Find someone that is local to you and has done what you want to do.
Yeah. And, I would say live in it, probably just live in it. Like, self-manage and live in the property. There's other ways to go about it. And that's not the end all be all answer, but you will learn so much by being on site, seeing everything that is going on, learning about property. A lot of people want to invest in property, but they don't know the components of a property. You live in a property, you self-manage it, you see things that go wrong, you watch people fix your, repairs and maintenance and everything that goes wrong with your property. You're going to learn very quickly. You're going to accelerate your learning curve versus, living out of state and buying in a small market just because the cap rate is high and you have no idea what's actually going on with your property. And when your manager tells you that there's a repair and this is how much it costs, you don't even really know why. I think there's so much that you can learn from self-managing for the first year or two, especially if you live in the property.
Man, I own a property management company, and that's always my advice. Self-manage, so so you could. I always thought so. At least you understand the value you're getting from property management. So and what you're looking out for. So, all right, awesome. What do you guys do for fun?
Like
I
Mike mentioned,
yeah,
sorry, I got a
go
family,
ahead.
so I spend a lot of time with them. Mike still hasn't taken me up on my offer to babysit yet, so he says he wants a family, but he doesn't want to babysit. But yeah, and again, we like helping people and supporting our team. We have 24 agents on the team, so coming up with ways to grow is my passion, right? And I think everyone on this call has a very similar passion. We want to grow and provide. And for us, it's for me, it's providing for the team and kind of having some mouths to feed. So I'll leave it there for me.
No stamp collection or anything like that. No hobbies, dude. Anything?
Oh man, yeah, no, I mean, I'm super into, and I don't even know if I mentioned this last time on in here. I'm super into like hot sauna now. So I'm 6 days a week in there taking calls until my phone has the overheat alert go off.
There we go.
But I
There
have
we
one in
go.
my basement, so I'll plug hot sauna. I haven't gotten the cold plunge yet, but you'll find me in there. Um,
All right.
a lot more than you'd expect.
That's the answer what we're
There you
looking
go.
for. Mike, come
Yeah.
on, bring it.
Good, as that explains why he's out of breath when I call him. I thought he was just hustling over to the phone. He's apparently out of breath in the sauna. And yeah, I mean, I have not babysat for Jake yet. I feel like you need to address that yet, but he hasn't really asked. If he just provides a couple of low sugar protein bars and a couple of Powerade zeros and invites me over, I'll be over in 20 minutes. So
He's not lying. I haven't actually asked him. He's correct.
I'm ready. I'm ready. I know I'm putting it out there in the world, just like you guys have been doing. So, for me, I work out 5 days a week. I have really enjoyed it. I'm doing a little bit of a weird personal challenge right now. Shooting 100 free throws a day. And I started out, I was just below 50%. And now I'm up to, a typical day is, low to mid 70s out of 100 free throws. So, doing that for fun. But you mentioned, stamp collections. I have a stamp collection. I have a coin collection. I have a sports card collection. So I'm kind of a nerd in that regard. Yeah, a lot of little fun stuff. I play fantasy football. That is dominating my life right now. Jake and I talk about that a little bit as well. I've got 4 leagues and I'm in all 4 semifinals. So by the
Big
time that
weekend
this
for you.
airs, yeah, it's a big weekend. By the time that this airs, I'll either be very happy or very depressed. So we will see. But a lot of little stuff regarding collectibles and sports fitness.
So the 3 married guys on this call all are thinking, man, the motherfucker's got way too much time. Like on his hands to do 100 free throws a day. Like,
I had to drop the
excellent.
one fantasy league I was in. Couldn't
As you're saying that, I'm like, maybe I should start with 10 free throws. That's about all the time I have, and I can figure out a percentage based on 10 and go for 10 for 10 first.
Oh, yeah.
I'm still fielding calls. I'm still right there available.
All right, so Jay, kick us off with this one. What's a good book, podcast, or self-development activity you'd recommend to our listeners?
Oh, I'm gonna get the book I just finished reading. Let's see, The Bank on Yourself Revolution. I just thought it was super eye-opening. It's about again, it's a little bit boring topic, but I thought it was kind of crazy. It's about whole like life insurance and how you can borrow against that money. A really, really cool wealth building activity that you can relate to real estate. So maybe check this one out. I'll say it again since I showed it to the camera. The Bank on Yourself Revolution.
You got to check out episode 205. Nick Chaplin we had on here talking about Be Your Own Bank, and it was all about that topic. So
Same thing. Yeah, super cool.
Yeah, and I'll add, there's a lot of our people that are listening right now that have only ever bought residential. They don't, maybe you're an agent, you've never done commercial, so you don't really know what you're doing. Great intro to commercial book. And it's not just about apartments, but it is called Crushing It in Apartments. It'll teach you a lot of the metrics that you don't know. It'll teach you about office, mixed use, apartment investing, what DSCR is that Jake mentioned earlier in the podcast. And it's so much simpler of a read than commercial real estate really should be, but it is a great intro and it teaches you so much very quickly.
I actually remember that one when it was like the black and red cover.
I think so. Yeah.
I remember that one when I first started. It was
Yeah.
one of the first ones I got.
All right. Besides yourself, name one person in your local network you'd highly recommend to other investors as a quality resource.
Mike, I'll steal our attorney, Carlos Aparicio. He's a little more local to me. He's in the suburbs, but he focuses on real estate law. He reps a good portion of our clients. So you guys can link to him, but it's Carlos Aparicio at Aparicio Law.
And I'm gonna, put his name out there and, probably not be able to get him when I need him. But I have a handyman. His name is Esteban Estrada. He can do anything and everything.
Throwing out the handyman, you're screwed.
I know. He's
Like...
gonna get so many calls now, and I'm sorry. He's, maybe he'll cut me some deals in the future, but just genuinely, I can't say enough about how important that is, because I am local. All of my properties are local, but I never have to go to them. I text him. He coordinates with the tenants. He gets it done. He's very fair. He's very honest. He tells me, what happened, what I need to pay him. He's always ready when I need him. He might not be after I put his name out there, but it's been a lifesaver. And, I think eventually everybody should get property management. Talk to Mark when you're ready for it. But if you're not quite there yet, get yourself a good handyman. It'll be a game changer.
Yeah, those bedside manners also highly overlooked. Someone can be great, but if they can't communicate, like half the time, that's all a tenant wants.
Oh yeah,
for sure.
Yeah.
All right, guys, thank you so much. You both provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Yeah, reach out to us, theaxongroup.com or info@theaxongroup.com. That email comes to both Mike and myself. Happy to help. We're here in Chicago. We have a investor friendly focus, right? Within 50 miles of the city, and always happy to talk shop, get you on kind of our deal list that we pop out every once in a while, and hope to add value for people now. And, not only in the first investment, but the investment 2, 3, and 20.
Awesome. All right.
And if you're a young investor, feel free to, go and find us on Instagram or the Axon Group there. We have a TikTok. We're not quite dancing on it yet, but, expect big things in 2024 with that. So find us on social
prediction
media
number
as well.
6.
Don't do it.
All right, Chicago Fact. Who's sponsoring? Who we playing for?
All right. Today's sponsor, Mike Procascio from Pro Financial Services Group. We are playing for Brad Chandler, who left us a 5-star review on iTunes.
All right, very good. So, Jake, you mentioned you're a suburbanite. I believe, are you in Burr Ridge? Is that correct?
Correct.
All right, good, because I have a Burr Ridge question. That would have been awkward.
Oh, wow.
All right. At one point in their life, all of these famous folks lived in Burr Ridge, except, so Burr Ridge was the home to 3 or 4 of these. Who was the one who never lived in Burr Ridge? And your options are Bo Jackson, Dennis DeYoung from Styx, Bill Murray, Derrick Rose. Which one of these did not live in Burr Ridge?
Did not live in Burr Ridge. I'll go with, I didn't grow up in Burr Ridge, but I will go with Bill Murray did not grow up.
Yeah, I know Bo Jackson did. I would say probably Bill Murray as well too.
Yeah, I'm curious on this one because I know Styx is very local. They're from the south side though. Don't know if they went all the way out to Burr Ridge. I think
that's a fancy south side suburb. Like if you grew up south side.
It is, but I know that they had a pretty strong presence around Mount Greenwood. My mom grew up around them. So I'm going to go off the wall here, and I'm going to say it's Dennis DeYoung.
All right. Bill Murray.
Bam.
Jake nailed it off the bat.
Wow.
I think Dennis DeYoung, it's the retirement, right? Like, done
Yeah,
plenty,
he
made
grew
his
up
money, get out the Burr Ridge.
We had Vince DePaul on here, who was the Styx manager from Your House Academy. I don't know what episode that was, but it was a good episode. But he was their road manager. And
yeah, that was awesome. We had to cut like 44 minutes of me asking him Styx questions. We'll release that in the bonus DVD editor cut one year.
All right, Brad Chandler, you get a $50 gift card brought to you by Mike Procascio at Pro Financial Services Group. So that was awesome. So Mike, Jake, thanks for coming on here. Tom, thank you. Listeners, Brad today was part of our Chicago Fact because he left his review. Not only do we want you to play for the Chicago Review or stand a chance to, those reviews help us get out there to more people like yourself so we could share people like Mike and Jake with more people like yourself. So help us help you, help everybody else. Leave us a review and you'll be entered for the Chicago Fact. Thanks again, Mike and Jake. It's always easy talking when you guys coming on. You guys are so knowledgeable and you guys are such go-getters. It's just, I love you guys bring such an awesome energy. Next time we're doing this in person. Tom, thank you as always. Listeners, we'll see you next week.
Thanks all.